So, well, this is one conversation that's been going on. But, of course, that comes at a time when we have a flurry of rights issues in the market. A rights issue, basically, for those of you who may be hearing, what does it mean by rights? It means that a company listed on the stock exchange is asking the existing shareholders to bring in more money by issuing additional shares or giving bonus. So that's what a rights issue means. But the man who is going to unpack a bit of this for us, from the rights issue to the capital importation, and look at the hot money versus cold money, is Omotola Abimbola, one of the investment analysts at Afrinvest Securities. Thank you very much. Let's have that handshake, but that's not going to be as long as the one with the governor.
Morning, Boston.
Good morning. Let's start with the rights offering market.
Okay.
This year has been a major boom. As we speak, we have one company, one cement company doing a multi-billion naira offering there. What's your take on this spate of offerings from, except the banks? Almost every other person, every other company or segment.
We've had one bank, actually, Union Bank, come out earlier in the year for a rights issue.
That's true. Yeah. Yes, that's Union. Yes. Union was the only one. But the industrials and the consumers seem to be the one taking the headlines. So UAC, Flour Mills, Lafarge, and the rest, they seem to be pushing the banks aside. The banks look very comfortable anyway.
You're right. Definitely. We have seen a flurry of capital, we have seen a flurry of rights issue offerings in the market since the beginning of the year, thanks to improved capital market sentiment due to flexible foreign exchange policy implemented by the Central Bank of Nigeria as of April 2017, which culminated in the opening of the high and hill window. And also because of the higher oil prices and improved appetite for Nigerian assets. So we have seen companies come out to the market to raise more equity capital, essentially to sort of deleverage their balance sheets, which became impaired during the economic challenges that we faced between 2014 and 2016. So for a number of these companies coming out to raise equity capital, for instance, Guinness, Unilever, Union Bank, and even Lafarge Africa, the intent of the money is to optimize their capital structure, reduce the amount of debt that they have, and increase equity. The only company looking to raise capital to finance an expansion plan is probably UACN, who are using the money to expand some of their products offerings across the cereal markets, as well as real estate as well. So speaking to the purpose, for raising capital, it's been two. One, to optimize balance sheets, particularly for the industrial goods and the consumer goods companies, and second, to finance expansion, talking about UACN's rights issue.
If banks or financial services company like insurance and commercial banks do a rights issue, perhaps folks think, well, what they just want is more money because they are already a quasi-money institution. Yes. But for industrials and consumer goods, what does that speak to in terms of what the purpose for the rights offering is all about?
I think it still shows that the economic recovery we are witnessing is still shaky at best. It is not yet on full steam because we are not seeing companies raise capital to finance expansion. Guinness, came out earlier in the year to raise some capital in order to, because in 2016, when we had severe FX illiquidity, they had to obtain some intercompany loans from their parent company. Same thing with Unilever. So right now, when we have improved capital market sentiment, they feel it is the right time for them to come to the market to raise some equity capital in order to pay off, those intercompany loans, and perhaps give the parent company the opportunity to also swap the debt that they give to the company into equity investments. Into investments. So we're seeing the same thing for Lafarge Africa. Lafarge Africa, when they completed the acquisition of Unisem. Unisem is a cement manufacturing company in Cross River State. They produce about, they have a capacity of about 5 million metric tons of cement per year. But while they were undergoing their capacity expansion, they had to take some intercompany loans from the parent company. And after the acquisition of the company by Lafarge Africa, so that obligation fell to Lafarge Africa's balance sheet, and they had to turn it in from a debt from a debt instrument, partly into an equity. Partly into an equity instrument. However, with improved sentiment in the capital markets right now, they felt this is the right time for them to come into the market, to raise more equity capital, to pay off some of those intercompany obligations, as well as, reduce the finance charges that are on their books.
If you look at the macroeconomy, and of course, when folks say, well, the stock market is not a true reflection of the economy. But again, these are big companies. They employ thousands and thousands of people. So we cannot discount that.
Definitely.
Again, you look at the consumer market. These are companies with very strong brand portfolios in the market.
Correct. But if you look at what's been happening in the consumer goods space over the past 1 year, of course, we have seen revenue for the companies. We have seen an improvement in it as of 9 months 2017, both revenue and profitability. However, that improvement in bottom line and top line is being driven by increase in products prices. So earlier in the year, many of them adjusted upward the prices of their products. So we are still not seeing a growth in volume. Because consumers are a bit challenged due to the high level of inflation and the slow economic growth. So I think the fact that we are seeing companies come to the market to raise capital, not to finance expansion, right, but to optimize their capital structure, shows that we still need deeper reforms in the economy so as to lead to real growth in volume of sales, that will necessitate higher capex investments by these companies.
Again, the flip side of it is that for companies with the headquarters, technically speaking, in Europe, perhaps in the US and other parts of the world, when you do a rights issue and you have your foreign majority shareholder say, look, we're going to give you dollars in cash to do what you need. If you do a rights offering, we're going to pick up this offering and convert it into equity. What does that speak to?
It also speaks to the fact that for many of these companies, the parent company actually still find the valuation very attractive. They consider that the valuation of their companies in Nigeria is at best, not up to the level that it should be. And if there is an opportunity for them to convert, their debt obligations into equity investments at the right price, they will take it because the long-term potential is still there. Nigeria is a frontier market, growing population at about 3% every year. With also very high GDP growth potential. So the long-term opportunities, are in the economy, but in the short term, we are still facing all these cyclical headwinds related to, the oil cycle, as well as, lack of structural reforms that's going to buoy economic growth in the country. So for them, they are playing the long game. That these companies, they're going to be here for a very long time. Let's support them as best as we could. And in the long term, we're going to, recoup our investment in these companies. We're
talking about companies that we can grab their financials off the shelf or just go online and pick them up. There are a number of companies that are, PLCs, not listed on any exchange, whether the NSE or the NESD, OTC, or even putting any bond on the FMDQ, but they're out there as limited liability companies in the consumers and industrial goods who are not captured by what we have right here on the table.
Correct.
So if you put that, if you look at that uncaptured production part of the conversation, where you have private equity, venture capital guys coming and putting dollars that just get a portion of the news reports, but because they're not listed on any exchange. Do you think we're making some progress along that line, even though we don't have the data right here at our fingertips?
Yeah, I think so. I think we have seen, some landmark transactions in the capital markets, in the economy, over the past couple of years, both in the consumer goods space and also in the technology scene as well. Although I would say that the interest has been more towards the internet startup space than even the typical, consumer goods or industrial goods segment in the economy, due to the level of innovation that we are seeing in Nigeria's startup space. So for companies, such as, Hotels NG, like To Let NG, and a number of them, they've been receiving lots of, equity funding, from foreign venture capitals, who are looking to play the long game in Nigeria's growth markets. But for the typical, consumer goods and industrial goods markets, I still think that for us to fully uncover the growth potential in these two segments, we still need deeper reforms in the economy. Per capita income is still so low, and we are not seeing, lots of spending by consumers. If you look at last year's GDP by expenditure data, you will see that consumer spending is actually declining in the economy. And for an economy where consumer spending is about 60% of total GDP, this is very, very important. If you also look at the last GDP reports for Q3, although we saw a positive growth of about 1.4%, the non-oil sector, which perhaps reflects what is happening in the economy more, actually contracted by about 0.8%. So we are seeing a recovery, but I would say that recovery is very slow and very sluggish, and there is a potential that it will be a long recovery if we don't see deeper reforms in the economy.
Yes, the state of the economy. What do you want to see to lift that side of this conversation? Foreign direct investment.
To lift foreign direct investment in the economy,
yes.
It has to be more reforms, both on the soft infrastructure side and the hard infrastructure. Soft infrastructure relates to ease of doing business metrics, such as construction permits, ease of entry and exits, out of the country, ability of companies to access finance. So these are very soft issues that could easily be solved if you have lots of political will going into implementing the ease of doing business reform. And thankfully, we have seen a positive performance regarding this in the past 3 or 4 quarters. Last year, the Presidential Ease of Doing Business Council was established, and they have done some work, related to trying to improve some of the soft infrastructure that we need to support investment in the economy. But be that as it may, we still need a lot of hard infrastructure in the economy. Investments in roads, investments in rail, investment in housing as well. So all these, and power sector. So all these things are very important to make our businesses very competitive in the global markets.
Okay. Let's, while we work on that, we'll put that as a work in progress. Let's come back after the break and talk about what's been described as hot money, which is portfolio investment, whether it's really hot or cold. We'll be back into everyone.